In 2022, the S&P 500 plunged over 20%, erasing trillions in market value. But here's the puzzle. The Federal Reserve only raised rates by half a percentage point at a time. How does such a tiny number trigger such massive losses? The numbers tell the story. Throughout 2022, the Fed raised rates 7 times, and with each hike the market dropped further. By year-end, investors had watched over $6 trillion vanish from US equities alone. The answer lies in a hidden mechanical chain, a step-by-step transmission mechanism that amplifies a small rate increase into a market meltdown. Once you see each link, you'll never watch a Fed announcement the same way again. To understand that chain, start with what the Fed actually controls. The Federal Reserve has a dual mandate: keep inflation in check and maximize employment. When inflation runs hot, the Fed's primary weapon is the interest rate hike. In March 2023, the Fed raised rates by just 0.25%. This seemingly minor adjustment acts as a trigger, initiating a mechanical chain reaction that reverberates through the entire financial system. And it wasn't just one hike. The Fed funds rate climbed steadily through 2022 and into 2023, each increase another turn of the screw, tightening borrowing costs across the entire economy. The Fed raises rates, but the damage begins here. The first domino to fall is corporate borrowing costs, which spike by 1 to 2% almost immediately after the announcement. That means a company that was borrowing at 4% now faces 5 or 6% on new loans. Suddenly, every dollar of debt costs significantly more to service each year. And that matters because corporations rely on debt for everything: building new factories, upgrading equipment, funding research, even covering day-to-day operations. When the cost of that capital climbs, the entire business model gets squeezed. Which means the rate hike doesn't just make headlines. It instantly rewrites the math on every corporate balance sheet. And that's exactly where the second domino starts to wobble. Higher borrowing costs hit the balance sheet hard. Companies now face a squeeze where revenue stays flat while interest expenses climb sharply, compressing profit margins by 3 to 5% for every 0.5% rate increase. The math is brutal. A company with $1 billion in debt now pays an extra $10 to $20 million annually in interest. That's $10 to $20 million that can't go toward expansion, hiring, or innovation. It simply vanishes into servicing debt. As a result, companies immediately start cutting back, delaying capital projects, freezing hiring, and reducing research budgets. Every department feels the strain as management scrambles to protect the bottom line. And the damage shows up fast in quarterly earnings. Moody's found that a 0.5% rate hike typically shaves 3 to 5% off corporate profits within 2 quarters, turning healthy margins into razor-thin survival mode almost overnight. But profit compression is only half the story. Here's where it gets critical. Wall Street analysts immediately recalibrate each company's worth using a higher discount rate. That discount rate is the mathematical tool analysts use to convert future earnings into today's dollars. It's built into present value models like the capital asset pricing model, and when the Fed raises rates, that discount rate jumps in lockstep. Here's the pivot. Imagine a company expected to earn $100 million 5 years from now. At a 4% discount rate, that's worth $82 million today. But bump the rate to 6%, suddenly it's only worth $75 million. And that's the key insight. The company's future earnings haven't changed at all, but what investors are willing to pay for those earnings today just dropped by nearly 10%, purely because of the math. So higher discount rates mean future earnings are worth less today, and that recalculation directly translates into stock price drops of 5 to 10%, sometimes within hours of the Fed announcement. That's exactly what happened in 2022. The S&P 500 fell over 20% as the Fed hiked rates repeatedly. Each hike forced analysts to recalculate, and each recalculation slashed the price investors were willing to pay for the same companies. Here's the crucial insight. Investors aren't panicking. They are performing rational calculations, reassessing the value of future cash flows when discounted at a higher rate. The market isn't broken. It's simply adjusting to new realities. But there's one more force amplifying the crash. When the Fed hikes rates, bond yields climb, and suddenly, those safe, predictable treasury bonds start paying 4, 5, even 6%. Which is exactly why the market doesn't just dip, it plummets. Capital floods out of stocks and into bonds, amplifying the damage. In 2023, bond inflows hit record highs, while equity funds bled billions every single week.
So, how do you spot this chain before it wipes out your portfolio?
Watch the CBOE Volatility Index. Market volatility typically spikes 30 to 50% in the days surrounding unexpected Fed announcements, signaling the recalculation is already underway. Now you've uncovered the entire mechanical chain. From the Fed's announcement to rising borrowing costs, profit compression, higher discount rates, and collapsing valuations. That puzzle from the start, how a 0.5% hike erases trillions. It's not magic, it's math. And with this knowledge, you can anticipate its impact on your portfolio. Quick note, this is for education only and is not financial advice. Always do your own research before investing.